What's going on, everybody? Another week, another Brady Bunch Ask Me Anything happy hour. As the money mentors start to pile in, we need you to pile your questions up because that's what we're here for. Don't come here unless you got questions. We want your questions. We want the hard questions. We want you to try to debunk everything. That's what we want. But, nonetheless, we're going to go around the block and we are going to help you solve your problems. But before we do that, we'll be right back after this. All right, as we get into it, it's another week, which means it's another round of webinars. And this is Ask Me Anything Happy Hour, where we get together like the Brady Bunch to answer your questions. So pile the questions in. We're going to go around the block here and do an intro for everybody, starting with the guy. Starting with that guy. Yeah, he keeps moving around. Tricky.
Oh, it's a beautiful day in South Florida today. A lot of good webinars. If you guys missed the wealth webinar at 1 o'clock today, definitely check that out on the YouTube channel. The recordings get posted typically on Saturday. So if you're not following the YouTube channel, go over to YouTube at the Chris Noggle, hit the little subscribe button and get alerted of all the great videos that get put up almost on a daily basis. But really cool show today. And of course, What the F this morning. So much going on in the country with the new president now in charge and everything that he's doing. So lots going on, but fun day today of shows. And other than that, I was just running a few minutes late. I've been really trying to organize a big hide and seek game, but good players have been hard to find. So that's where I'm at with things, but I'll pass it over to Brian.
So you can't find them because they're hidden? Hey everybody, Brian Foucher up in northern Idaho, looking at a lot of snow outside right now. So going to be in Sundance, Utah this weekend, looking for some warmer weather, right? It's going to be warmer and sunny and all that kind of stuff. No snow.
It's going to be sunny.
But a lot more snow. But yeah, up here, and had a great time doing the Take Back Control Tuesday yesterday. So hopefully we got some people on that were on this call that were on that yesterday. That was a fun one. Had a lot of great questions. So with that, though, I'll pass it downwards. Shauna? Yeah. She's muted.
Mute.
Talking to herself.
Mute.
Can't hear you.
Yeah, we're reading your lips. She just said a bad word.
We'll pass it over to Craig then.
Nope. You ready to go, Shauna? Otherwise, I'll go.
Her mic's not working.
All right. Craig Yenny here, and just like Brian said, we're heading out to Sundance, Utah here for some snowboarding, skiing, whatever you want to do, and just getting together as a group. But Stephen, you had mentioned you want to create this hide and go seek game, and we watched a movie a couple weekends ago. It's about a true story of a group of guys that played tag into their adulthood. So do you guys ever see that movie? It's so crazy. Yeah. It was so funny. It's like these guys are playing tag through their whole adult life. But anyway, pretty crazy. That would be kind of fun to do.
That was a good one. Oh, by the way, some news we left out this morning. Groundhog Day was this past weekend.
Yep.
And yes, the shadow is seen. So 6 more weeks of winter to all you poor souls that live in the cold weather. For us in Florida, it's a beautiful thing because we love this time of year. But with that being said, I also watched this week Groundhog Day, the movie, one of the best movies of all time. And just leave it at that.
All right, on to Joe.
So I will not be going to Sundance, and I'm very sad about it, that I'm not going to see anybody out there and have fun with my favorite people. But on the other hand, Ariana is going to sectionals for rifle, so I'll be there cheering her on behind her. So
Awesome.
That's what I guess we lost Shauna. She didn't get the mic.
Oh, she's got to get her mic going. But everybody, get those questions in. All right. So I think we have at least one question came in from Brian Young so far. So let's see here. So Brian, nice name by the way, said, I have a first lien HELOC and I'm pretty close to having it completely paid down. Myself and my 3 sons also have infinite banking policies. I currently have a loan outstanding on my policy, but nothing on my son. So one question to you, are your sons over 18 or under 18? Are they juvenile policies or adult policies? And then the second part of this question is, my question is, should I start a new policy for my wife or wait until the HELOC is completely paid off, or to have it completely paid off and the policy loan paid back?
Joe, why don't you take a stab at this one, since it started with your area of specialty, which is HELOC. But I mean, I think all of us can comment on this one.
Well, first of all, you have money in the HELOC. Money not in motion does not make money. So why isn't that money being put to work? That's first. Second of all, we want to make arbitrage on any of the money that we have and put to use. If the policies have room in them, we could do extra PUA. We could fill those up. What are you going to do with the HELOC once it's filled? Are we going to put that into an opportunity? If we are, then we might as well run it through the policy and create another one for your wife, and then utilize that for the opportunity to make more arbitrage.
Yeah. Lots of options here. Depends on kind of what your goal is. Like, what are you trying to accomplish with the HELOC, with the policies? That can kind of help dictate what you're going to do with them. Because I had this conversation with the client, I think it was today or yesterday. Tess was on, by the way, on that call. And they're saying, oh, I can't wait to pay off the HELOC. My question was, okay, what are you going to do with it after that? And they're like, well, what do you mean? It'll be done. I'm like, well, you have this $300,000 HELOC that's just sitting there on a shelf doing nothing, pretty to look at, but doesn't work for you. What's the whole thing we try to do? Get your money working for you, whether it's from the policy loan or from a HELOC. If you can get it working for you, that creates cash flow. That changes your life. So kind of like understanding what you're trying to do with it is a big part of that answer.
I mean, I'll just comment on that. I mean, like when you have a HELOC, I mean, yeah, I mean, the average folks, want to pay their HELOC off because usually they took the money out of the HELOC to do something with it, and it didn't create income. But, I don't know your scenario with what you use the HELOC for, but obviously, the goal would be to take that money in your HELOC and get it out there working in a really safe or very calculated place where you can make an arbitrage. Because obviously, if you're going to be the bank, which sounds like you understand because you got IBC policies, you want to keep that money working. Secondarily, I would never wait to start another policy until my loans in my current policy are paid back. That's like defying that would be like saying a bank is not going to take, or let me try to phrase this. I'm trying to give you like a parable. So like banks take deposits in and they lend that money out. Banks do not take deposits in and put all the money in the bank, in the vault, where it just sits there before they lend it out. So that would be like a bank saying, okay, we're going to take deposits in, but we're going to lend no money out until we fill that vault up. When the vault's filled up, then we're going to lend money out. The bank would lose, they would go out of business. They would lose a ton of money, but that's kind of like what you're saying. So when you're trying to be the bank, when you're using the infinite banking concept, remember, you got to think as if you are a bank. Now, would a bank take deposits and just pile them into the safe, into the vault? Never. It's a non-revenue producing activity. So you want to think the same way. So as money comes into your policies, that money should be redeployed out to keep doing, the taking back the banking functions, whether it's paying down debt. Now, here's one thing I would say, and Joe, like earmuffs, but depending on what your HELOC is for, you could be taking money from the policies, because it doesn't sound like they're all loaned out. It sounds like yours is. And you could be using that money to pay back the HELOC. Because think about that. Like if the policy charges you 5 or 5.5, but the HELOC's charging you 8, you're making a nice spread. That's one way to look at it. But I would never, ever, ever suggest somebody waits to start a second policy, either on themselves, a wife, a child, until all the debts are paid off. Again, there's more to unpack in terms of your needs, your goals, your current situation, but that would all be solved with a simple phone call with one of the mentors. So we'll put it up in the link, but I would definitely say you should and actually need to book a call with somebody just to kind of talk this through so we can understand more of the details. Sorry I went long-winded, but that was a great question.
I would like to hit that one right there.
Which
want
one?
no liabilities.
Yeah, there you go. Yeah.
So, all right, how about a personal example? I had a $400,000 HELOC at Bank A. I walked into Bank B. They gave me $350,000 more. So I had a 400 at one bank. The next bank said, we'll give you 100% equity. I walked into that bank. They gave me 750. I paid off the first lien, or the first lien at that point in time, that 400. I now have 350 in my hand. I took that money, put it into an opportunity. Now I'm bringing in cash flow, more cash flow than just what that 400 was giving me. Yes, I have a HELOC that I owe 750 to the bank, but I have 750 in opportunities. Is that a liability or is that an asset? I am making cash flow. That cash flow, call it $10,000 a month, is now paying that $3,000 a month HELOC. I have an extra $7,000 in my hand because I am using leverage. I am using the bank's money, making it into an opportunity, creating arbitrage, and that's how it turns into an asset. You're on mute, Chris.
Yeah, that last thing I'm going to add to this, because that was great, Joe, is, where he says his last comment, Brian, you said, I want no liabilities and my kids are under 5. So the kids under 5, we're going to ignore that for a second. That's irrelevant, really. But you want no liabilities. So let me ask you a question. When a bank makes a loan, okay, when a bank puts a loan on the books, don't care what kind of loan it is that a liability to the bank or is that an asset? An asset.
Asset.
The deposit the bank takes in is a liability.
Mhm.
The asset is the loan. The loan, you need to reframe your mode of thinking. And I know, Brian, it's super hard because of everything we've been taught our whole life is get out of debt, get out of debt, get out of debt. But you have to understand debt. You have to understand good debt and bad debt. But you also, more specifically, don't even play that game with good debt, bad debt, because I think all debt is bad. But when you take a loan from a policy or you take a loan from a HELOC, and you lend that, so you take a loan from we'll just use your HELOC, take a loan from the HELOC, but then I take the money that I took from the HELOC and I lend it out again in a really conservative fashion, like PMC, first lien position, personally guaranteed with a reputable borrower, and I lend that out at 12. If the HELOC charged me 10 and I lend it at 12, you're making a 2% spread. And I know it'd be a lot more, but that is an asset because it's income producing. So I almost hate to say this, but go back and read Robert Kiyosaki's Rich Dad, Poor Dad. I think that book does a great job of explaining assets and liabilities, but also good debts and bad debts. But I really think, Brian, it's just a reframing. And I get it, dude. It's hard because we don't want liabilities. We don't want debts. We want to just owe no one anything. But in banking, if that's truly where you're trying to go, if you want to, be the bank, you will always have loans, but those loans will be assets that are producing revenue, that are making it better for your family, that are allowing you to expand your finances for your family, get out of debt for your family, and also for your 2 kids under 5, which I relate. I got a 4.5-year-old, so not far off, like allowing yourself to set them up because your money's out there working instead of you being out there working every day, not being with your kids, spending time to make money just to get out of debt. That's backwards, dude. That's what you've been taught your whole life. And it is a broken, backwards, lead nowhere system.
Yep.
Yeah, I was just going to add, Chris, I'm glad you brought up Robert Kiyosaki because I was thinking there's the Dave Ramsey mindset where all debt is bad all the time, always, always, always. And then there's Robert Kiyosaki that talks about using debt in a good way to build assets, just like all the stuff we've been talking about. And, if you think about, because I've got a first lien HELOC and I've got multiple policies. And so if you just kind of draw a circle, all your income goes into your first lien HELOC. You might even be paying your premiums out of your first lien HELOC and your policies. You might be taking cash value out of your policies to put it into a deal to invest. All that money comes back into the HELOC. You pay your premiums and you're paying your premiums and your loan interest out of your HELOC, and you just keep the money going in a circle around and around, and the money gets dizzy, but it just keeps moving and moving. And Joe, I know we've had these conversations. I'm on my, I think, 4th time of paying my house off. So I'm now at a point where I'm a little cash heavy, but I'm also a little resistant right now just because I don't know what's going to happen in the world. So I'm not fully deployed, but
you have that option.
But I have the option to go roll it back out again.
And what a glorious option that is it not?
Yep.
It is
So when
awesome.
the right thing pops up, then we'll deploy. But for now, we're just sitting on it.
Awesome. Love those answers.
I'm gonna I'm going to send something to you, Snaggy. I don't know if you can post it or not, but this is exactly what Craig was saying. That's my all-in-one drawing.
Man, Brian is getting some serious love today.
And not this one, the other one. All right. Yeah.
All right. Should we go on to navigate your ventures?
Yeah. So navigate ventures. Question here. Been diving into Money School TV and jumped to stock market and trading video from 2020. So about 5-year-old video. Would you say this is a repeat after 5 years, 2 years ahead of the 7 to 10 year cycle?
Yeah, it's interesting you should bring this up. I mean, we haven't really started talking about it much, but MSTV is making its comeback, which is Money School TV. And you're probably referring to the videos I created back 5 years ago during the pandemic, all about that. Everything in those, I just want you to know, everything in those videos, those options and stock trading videos that I did back then are 1000% relevant today. And I'll prove it. Monday. So in the office Monday, if you all remember, that was like the day DeepSeek kicked in. Was it Monday, the DeepSeek day? It was, right? Feels like it was last week, but it was Monday. And the market tanked. So I saw a solid trend in the market. And in those videos, trend is your friend. I took positions. I didn't do them right at the open of the market because that's usually a dangerous time because the market can flip real quick. But I saw a trend. I took puts. Okay, I did I bought, I think, 3 put options on the S&P 500. I was in that trade. I'm not bragging, and it wasn't a big investment. I was in that trade 5 minutes. I made the trade. I checked my email. I came back. I was up $3,300. I sold. So I made $3,300 Monday. Now, later in the day Monday, I'm like, well, let me double dip, right? Like if you go in once, you might as well go in again. It's just a little later in the day. So I went back and same thing, but I did it with NASDAQ because NASDAQ was really kind of wavering at the end of the day. And I did the same thing, took puts out on the NASDAQ, the index, okay? And I closed those out. I didn't make as much because it was kind of the end of the day and it was all over the place, but I made another $1,600. That was just one day because of applying exactly what you're referring to in MSTV. So now I'm not saying that you're going to be able to repeat that. You'd have to find a day that has high volatility in one particular sector. But all the teachings that happened in MSTV back in 2020 are now fully relevant. You are at that cycle. So we are now at another cycle here. So you mentioned a 7 to 10 year cycle. It's more of a 5 to 8 year cycle. We are there again, but we got to wait for the trend. So if you're going to learn from what we put up on MSTV or the 10-10 trading, which we're going to get up on the new MSTV training, that's going to be super robust. Then you will be able to start applying that stuff once we get a solid trend going. And just last thing I'll say, and some of you don't understand this, but get on MSTV if you want to understand what Navigate Your Ventures is saying. Trend is your friend.
Absolutely. All right. So Alex had a question here. I was just told about this. I'm assuming you're referring to infinite banking, but what is a whole life and IWL policy? I'm assuming IWL is indexed whole life, but I'm just guessing.
No, I don't think there's really, index whole life is whole life. Yeah. It's just dividend buys, just instead of going, to increase the PQAs, it goes to the indexed option, which I hate how One America does that every year. They ask you, it's kind of tricky, but so it's hard to, like, you're asking what a whole life is. A whole life is simple. It's a policy you take out for your whole life. It builds cash value. It is guaranteed. The cost of insurance is guaranteed from day 1 to day 121. And if it's done through a mutually owned insurance company, those insurance companies have paid dividends for well over 100 years, or actually over 140 years for the ones we use, consecutively, never missing one. So the IWL, if you're referring to the indexed option within in a whole life where the dividends every year that get paid out to you can go into the indexed option, I think you'd be a fool to put money into that, first off, because the markets are not going to continue to go up like they have. They're definitely probably leveling off and definitely, in my opinion, going severely down. So why would you ever want to index anything that ties to the market right now when you're at the top of the market and the only place to go is down? Stand at the edge of a cliff. What when you look over the edge of the cliff, does it keep going up? No, it only goes down. That's where we're at in the market. So anything with the word index in it right now, I think it's a terrible, terrible decision to put your money in it. Index universal life, whole life with the indexed rider or the indexed option for your dividend, indexed fixed annuities, which I don't disagree with them. I like indexed fixed annuities, but right now it's just, there's a right time for things and a wrong time for things. And now is the wrong time to go indexed. In the long run, maybe you squeak out a little more, but you really need the freaking headache. Like, wouldn't most people just like to be said or to hear, hey, you're going to make 4.5% forever? Like, wouldn't that be nice? Or, hey, you're going to make 1% guaranteed. Well, you have the option to make 7, but it might be 3, it might be 5. Do you really want that in your life? Do you want that? It's an honest question, and it's different for everybody. I just did a call with somebody yesterday that has indexed annuities, fixed indexed annuities. They've done really well, but they've done well in a bull market, in the longest bubbled bull market in history at this point. Do you really think it can keep going up? And if you have any doubt about that, remove the I from anything except for I am.
There we go. All right, J10.
I have that graphic too, Joe, if you want to hit that at some point.
Go ahead.
Okay, I mean, you could put it up because
Let's do it now before we get to Jay's.
Craig was talking about the system, about the 360. So that's the one pot system. So the HELOC is the nucleus. That's your savings account, your checking account, the investment. So now we take that money, we run it through the policy, take it out of the policy, put it in an opportunity. That interest that comes in goes back into the HELOC. Your paycheck goes into the HELOC. Everything that goes into the house goes into the HELOC. Out of the HELOC, we'll pay our monthly bills. We'll pay the HELOC out of the HELOC, but it's the nucleus. So then by putting the money into the HELOC, that's actually doing the velocity banking part. So the HELOC average is done by a 30-day average. So if we put money in throughout the month from our paychecks, from the interest, from our rental income, it keeps on taking that principal and dropping it on a daily basis until, say, the 25th or the 28th, when they take out the HELOC payment for the previous month. That's when we're going to pay the monthly bills, pay our credit card. So then for 25 days, we kept on decreasing the principal and only increased it for like 3 days. So that's how the interest is derivative of the 30-day average. That's how you're able to use velocity banking with a HELOC with a one-pot system. Okay.
Nice picture, Joe. Nice
Thank
picture.
Great drawing.
The one thing
Colored in the lines.
You like
Yeah,
that?
one thing, Joe, just maybe to clarify on the arrow going from the HELOC to the policy to the investment. So there's really two things going to the policy. There's the premiums and loan interest, right?
You asking me? Or?
Yeah, I mean, do you say that there's HELOC money paying the policy premiums and there's also HELOC money paying the loan interest?
Depending on what it's going into. If it's going into the opportunity, you would rather pay that HELOC interest because that is like the straight going. The interest on the policy after a year, in the first 3 years are going to be, probably negative. But once it gets into 4, 5, 6, and 7, and even in year 10, now you're at 200%. So I guess it depends on the policy. It depends on what we're using the policy for. Depends on the interest coming in. There's a lot of derivatives that would go into that, but
yeah,
it depends.
But I think that flow. But hopefully that helps people see the circle of money floating around.
Yeah. Cool.
Definitely got his money's worth on today's show. Oh, he didn't pay? All right. Shauna, send an invoice.
Can you hear me?
Yeah, we got you.
Yeah, you're there.
I'm on my phone now, so I'm better now. But my computer won't work. I'm looking up microphones right now.
There you go. All right. J10 says, do you write convertible term policies to have the best whole life policy in place when it's time to convert?
Gosh, I wish Tess was on here. Yeah, of course we do. We were literally talking about that offline right before we got on here. So there's like 3 companies that have really good convertible terms. One I would only recommend, me and Brian were talking about it, only recommend if you were going to convert like in a 3 to 5 year period and you knew you were going to convert it. And then the other 2, which I'll just call them out, Lafayette and Mass Mutual, have really good convertible terms that work really well to protect your insurability, but give you the ability to go into a specially designed whole life.
Yeah, good question. And Chris, so what's a scenario where you would do a term policy and not a whole life to start?
Yeah. So, and actually, great question, Brian. It would be like somebody, really loves IBC and they see the future and they want to do it, but maybe they've got some headwinds at them right now. Maybe they're switching jobs, they're getting a raise, they're paying off some debts, something's happening, and they don't have the funds now, but they're concerned that when they have the funds, that maybe their insurability could change. You never know what can happen. I mean, have you watched the news about airlines? Like just today, 2 more airplanes collided. Like what the F is going on? I don't even want to get on a plane. I'm kidding. I'm going to have to get on a plane, but nonetheless, like you just don't know. So the term allows you to protect that insurability no matter what happens. A trip and fall, you come up on a handrail a little bit too excited, stand up a little too straight, you go back over and the rail hits you in the back. I mean, it happens. Then all of a sudden, maybe you're not insurable. You never can tell. So if you're worried about that, the convertible term takes care of that. So I'm not going to say pennies, but a pretty inexpensive cost of insurance for a convertible term is as long as the client knows and is committed to eventually within that 10-year time frame converting that into a policy.
Yeah. And one question we get quite a bit is someone says, "Hey, I want to convert my term." The question I ask right off the bat is, "Are you insurable?" Well, yeah, absolutely. Then there's no reason to convert the term at that point in time. It's because they're insurable.
That's a really good point. A really good point. Don't convert the term if you're still insurable. Just do the policy, keep the term in place until that later day, especially because term is, depending on your age, very age specific, but term can be very inexpensive and can be a really good tool. I literally, and I'll be honest, and everybody on here knows that like I'm not a term guy. Like I don't go out there and talk about buy term and then invest the difference. That's Dave Ramsey. But just today, I put another term policy in place on my life for $5 million. And I did it for one of my companies. So it's a key man policy to make sure that if I die, trying to be 18 when I'm 47 in the snowboard park, that there's a big windfall of money that goes to my company to make sure that my vision for changing the banking system and disrupting that bastard is going to be fulfilled. And they'll have $5 million to make sure that happens.
There you go.
Yeah, I think the other piece that makes some sense.
Shauna.
The other piece that makes some sense on that term is, so Chris, we've worked on that business plan. 2 business owners, one do a buy-sell agreement, meaning one falls off the side of a cliff, the other's got to take the
other one
gets the money and buy the business
accidentally.
So they weren't able to fully fund their buy-sell agreement to do a full buyout with whole life. So we used as much of the whole life as we could, and then we put term in with it so that the death benefit would fully fund the buy-sell agreement. And so over time, as they got more revenue in the company, they could convert chunks of that term into whole life. So it's a beautiful, beautiful plan. So term can really help in business situations and insurability situations. So it's a good thing to think about.
Yep. For specific purposes. Yeah. So this is for you, Joe. What's the bank near New York or in New York near the city that offers the first lien?
I'm going to have to get back to you because I just had a client that found a good one that worked well near the city. And my bank that we use for the other 45 don't do New York anymore. So I will get that answer and let you know.
Nobody wants to do business in New York.
Yeah, nobody. Not even our insurance companies that we work with.
Oh, I'm well aware.
Are you guys fine because you already have them? Or how is that going to affect you?
We're fine because we already have them.
Okay, just wondering.
So John asked a question here. I'm semi-retired at 67. I've got credit card debt and a timeshare mortgage. How do I turn that debt into wealth? Not much cash flow either, but have $15K to dump into a policy. Suggestions appreciated.
Book a call, 100%.
Yeah.
that's one that we just got to dive deeper into. Like, I love the question. I wish we could just be like, hey, you just do this, 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 and this. But there's a lot of questions we'd have to ask, and then we'd run modeling and show you the mathematics around that. But it's definitely one of those where it's like, we don't, at this point, you got credit card debt. Great. Like, we need all the specifics. And I don't think you want to air that laundry here, and then timeshare mortgage. We need all the specifics, the payments, the term, the interest rate, all that. And then once we have all that, it's very easy for us to say, okay, here's how we're going to turn your debts into income, or your debts into wealth. As we always say, turn your debts and expenses into wealth. And that's exactly what you will do, but requires booking a call.
Yep. And the link's in there already above, so you should check that out. All right. Mr. Bob Anderson says, hi, do we know whether to pull all monies in one policy, put all money in one policy, or split it up? And do we put it in up to MEC limit, and when that and loans paid off, start another one? So it's an interesting question. So it depends on your situation, to be honest. It depends. It's like, a common answer, but so I did a couple yesterday, and they have this much money to put into a policy, and they're saying, okay, I'm going to put it in on the husband as an example. My first question was, what's the income in the household? Oh, you both have income. So in that scenario, would you want to insure both incomes in case something happens? That's the purpose of insurance, but also do infinite banking. So what we're doing now is they're both doing a policy and splitting the dump in or lump sum into two policies. So now they have full coverage on the household. So it's more information that we need so we can provide a more detailed answer on your situation. And then, of course, somebody else wants to answer the MEC limit on this one.
And I think one thing, like, a lot of people, we get this question a lot. Like, should we do one policy, or should I do, 3 policies? One on me, my wife, one on my kids. It really comes down to, where's the risk for the family? I was on the phone with a dentist the other day, and this exact question came up. Husband, breadwinner, like owns the dental practice. Wife works, in real estate, manages the real estate that they have, and then they have their kids. His question was, do I take all the money and put it into the policy for me, or should I split it up, put some on my wife, put some on the kids? And I said to him, where's the biggest risk in your family? If you're gone, does your business continue? The answer was no. I said, if your wife is gone, does your business continue? Absolutely yes. Not that this is fun to talk about, and then the kids, you already know. So I said, no, the number one thing you want to do is protect the breadwinner. It'd be no different than any sport. Like, if it's soccer, like, the goaltender is the one that doesn't want to let the ball in. That's a bad analogy, but you got to protect the main breadwinner in the household. And that would be you, probably. But again, if the breadwinner is your spouse, protect your spouse first. If the breadwinner is both of you, split it up. But you don't try to split it up across your whole family just because you think, oh, well, the kids are younger than I am. That's a completely false. That's a myth, because you're not going to be able to layer much into kids' policies. The best I've ever been able to do for my client, or for kids, one of my clients wanted to put 50 grand in for each of his kids. And it literally was like pushing a boulder up the hill to get the insurance company to approve that, because that buys a lot of life insurance on, a minor. And the insurance companies don't like that. It's a lot of risk for the insurance company. I mean, yes, the probability of something happening to a child is very low, but it's still a risk. So it's always best to protect the breadwinner. And if the breadwinner is you, there's your answer. Now, the MEC question, somebody else can answer.
Yeah, I mean, I had this question today. Someone says, what does it mean by max funding, and do you max fund policies? Yes, max funding means funding the policy up to the MEC limit, not above it, but up to it. And that's how we build them. So for sure. And then there's a third part to this question. Are loans paid off to start another one?
Again, this could be like what we first have to know, what loans, because we could very easily give the wrong answer. Like, the loans on the policy, then no. Yeah. Your outside loans, like your debts, maybe not.
Yeah. That's a situational one for sure right there. Just need more information on that one. All right. Let's see, what's the next question we got? So another one from J10 says, would you suggest putting an investment property into an LLC? Tenants are extended family. Where's that disclaimer? So not financial advice, not legal advice here. But for me, I mean, I would always put an investment property into an LLC, because that is asset protection. So it protects your personal assets from the investments. So in that regard, yes, it doesn't really matter who the tenants are in that regard. It's just protect your assets, protect your investments, put them in LLC. It's usually the advice that I get from, the attorneys. So.
And J10, I have an answer for you. First New York Credit Union, 90% LTV with an intro rate of 2.99 for 13 months. So you can go there and check it out. And once you get the information, you can give me a call. We'll do a strategy call and move from there.
There you go. What was that? What was it again? What bank?
First New York Credit Union.
There you go. All right. Eduardo has a good question here. How can I use infinite banking to pay my new car loan if my 90% of my cash value is already loaned out? What is the benefit of paying my IBC loan first, then getting a loan to pay my monthly car loan? So if you have a loan already outstanding on your policy, if you've already loaned it all out, you can't get a second loan until you replenish your cash value. So that's one thing. So you'd want to put some money back into it so you can loan it back out again, I guess is what you're kind of asking. The other option is if you have the capital to purchase the car, you could always put it through a policy, another one, second policy first, and then borrow back out for that car.
Yeah.
I guess go ahead, Shauna.
Well, I know that Joe, you love lending out your money so that you can make those car payments with that cash flow, I think. And then, like Brian said, if it's all gone, you can't really grab any more.
I was going to ask, what did you spend the 90% on? Did you use it to pay off debt that you still have to recapture back? Did you put it into an opportunity? Are we getting cash flow?
Yeah, there's kind of a few ways you can do that. I mean, if your policy is loaned out, it depends on what it's loaned out to and how it's being replenished, or paid back. That's a big part of that right there. We don't know.
It's like he bought some Bitcoin.
Yeah. Gamble. So we need more information on that one, on what the loan is in right now, and then what your cash
it's Bitcoin. He bought Bitcoin. Yeah. So
yeah,
For real?
So kind of what we were talking about is that if you had a cash flowing asset that you use the 90% for, you could just run that back through the policy or use that to pay debts. But I mean, I think this is going to require a call as well, just so we can understand the cash flow that's moving through the system.
They're great questions. It's so hard to do it just with limited knowledge, and we don't want to give the wrong advice because we don't have all the details.
Yeah.
Yeah.
But there was another one that's, if you saw, buy Bitcoin.
Well, that's what he did with it, I think is what he's saying. He bought Bitcoin.
Yeah, that's what I mean. He said he bought. It should say bought Bitcoin.
Yeah. Gotcha. All right. Orange Juice or OJ said, I have a policy that I pay premiums monthly. I'm thinking about going to an annual premium and just keeping the monthly payments in a HYSA until the end of the year.
That's not a bad idea. I'm not against that at all. I think right now seize the opportunity. I mean, these high interest rates won't last forever. So while the banks and the high yield savings accounts are paying the interest that they are, I mean, why not?
Yeah.
Terrible idea. I mean,
yeah. There's not a lot of cost saved by going annual, because he has a second part of the question here. Does the cost saved by going to an annual premium payment make sense to do this, or the monthly cost negligible? There's a small fee for the ACH. That's a bank fee that that exists, but you're going to be getting higher dividends on the annual side of it because it's going to have a higher balance throughout the year. So you're going to earn a bit more dividends on it. So annual in that regard typically does show a bit more beneficial numbers.
I have a question. If they're going to annual and they're putting the monthly into a high yield savings, do we owe money to the policy? Why aren't we paying back the policy?
If there's a loan, yeah.
And if there isn't a loan, why aren't we moving the money?
Good question. Money in motion makes money.
So something's not right with something.
Yeah.
Well, the one piece here that does make sense is if they are going to annual, they need to be ready for the next annual payment. So you can't deploy it all and then run into a cash flow problem at the annual premium.
Well, they have in the the yield account, they could take it out of there, correct?
Yeah, and that's what I'm saying. So we'd still want to have something set aside for that annual payment that may not be going out to work right away.
Yeah. All right. Adar says, what you would prefer as whole life, IUL or FIA policy? Or whole life? Whole life. That's pretty simple right there.
No question. If you were on Wealth Webinar today, I think that was probably one of the most defining reasons why you should only look at whole life, especially if you're thinking about, applying the infinite banking concepts in your life. IUL, first off, does not work for infinite banking. FIAs, fixed index annuities, I would have guessed that's what you're saying. I think, that's not even in the same league. Like you're talking soccer versus baseball there, but whole life versus IULs, first off, they're dog shit products. I'll be the first to say it. I get a lot of shit for that, but there's so many reasons why IULs are a problem. In a couple things I'll point out on that. When you look at someone like a life settlement company, who we had a guy from a life settlement company on today, like the majority of the policies that they're buying are IULs. Why? It's not because they overperformed and they crushed it, because the clients wouldn't be getting rid of them if that was the case. It's because they are sold on hypothetical pretenses that never materialize. Me and Chris Kirkpatrick have had $10,000 on the line for any jackass IUL agent. I'm calling you all out. If you're on here, fucking bring it. Like, if you've got an IUL policy that you sold 10 years ago, show me the illustration that you presented the client 10 years ago, and show me a new in-force illustration that's 10 years and 1 day old, or however old it is, as long as it's 10 years, that beat the original illustration. This should be a slam dunk for all you IUL agents, because there should not be one IUL policy that has not outperformed the original illustration. We've been in the longest bubbled bull run in history. For crying out loud, the S&P did over 20% this past year. So you can't tell me that your IULs haven't outperformed the original illustration you showed at 6 or 7%, right? 10 grand. Not one person. It's been a year. It's been over a year. Me and Chris have had this out there publicly.
Yep.
Not one agent has brought us an IUL policy and collected 10 grand. Not one. So what would you prefer, a whole life or an IUL? Do I need to answer that?
Mm-hmm.
What is the avatar of like somebody who would want an IUL and that it would work for, if there is one?
Hell if I know. I mean, maybe somebody that's 25 years old that takes out an IUL, overfunds it, it's built properly, it's got the right riders, which reduce the agent's commission, and they let it ride. They continue to fund it the entire time, and then at age 50, they start drawing it out for retirement.
I was going to say retirement, 100% retirement planning, but not banking. Not
okay,
banking.
yeah, so it's for retirement.
Then Craig and I can come in and show you that you could do the exact same thing with a specially designed whole life. Probably.
Yeah, the whole time.
Yeah, but I'm trying to like draw straws here and try to give you something that an IUL could potentially be a good solution for. And I guess if the markets continued to perform and, Trumpism really kicked in 2 years, the markets were crushing it, maybe then with that kind of a time horizon, it'd be good. But there's nobody that will ever be able to tell me that IULs work for IBC without literally ending in a fist fight in a dark alley. So what's your Stephen, you put a disclaimer in there.
All right.
So if we're mimicking what the bank does, do banks put money into whole life or IULs, Chris?
Well, look it up. Why not do the due diligence? Don't ask me, Joe. Like, Google it. And the answer you will find is a resounding no. Of course, banks would never put money in an IUL, because banks wouldn't be allowed to put money in an IUL. They wouldn't.
Absolutely.
So there's everybody's answer.
Oh, wait. Are pension plans buying up IULs in droves? No, definitely not. Yeah.
Kind of strange.
And if a settlement company buys your IUL, what are they going to do? They're going to pay minimum funding cost of insurance and just ride it out until the day you die, which means there's no value in the cash value.
And what was interesting about that life settlement discussion is he said it is rare, very rare, that they have the opportunity to buy a whole life policy, but IULs are pretty common.
We do. Who made that up? The
Who made
IUL
what?
the IUL
IUL
unicorn.
unicorn.
Oh,
I don't remember who came up with that, but it was funny.
Yeah.
I don't know how many of those shirts we sold, but however many it is, it's not even close to enough.
That's funny. All right. So Peter has a question here. It says, will you be able to convert that 5 million term to whole life later? Talking about yours, Chris, or do you have to get a physical exam again? So let's talk about your new $5 million term policy.
So all right. So Peter, that's a good question, Peter. So the 5 million I took out for Private Money Club, I took out for 15 years because I know there's a risk for. It better not ever take 15 years because I'm going to exit PMC. I've said that a million times. I'll say it right here live. $350 million is my number. When I get $350 million, I'm out. And it should not take us more than 5 more years. So when I calculated the risk to PMC, in my involvement in PMC, we had to come up with an arbitrary number. We came up with $5 million. And 15 years was the term I took because I know without a shadow of doubt, I will not be part of PMC in 15 years. So therefore, I will never need to convert that term into a permanent whole life policy because it's just that term insurance policy is solely there for protection if I die. We are not doing it for any intentions of cash value. Now, if PMC took off and had all this excess reserves capital, we might convert it and just do the 5 million in whole life. And then PMC pays the premiums and gets all the money back for the future. But again, that would even be probably something I wouldn't do because I would just take the difference in the premiums and I would dump it into marketing because my exit for PMC is well before the term of that term policy. So the function and the purpose of that coverage has nothing to do with whole life or banking or anything else. It is solely pure protection for a specific term of time.
There you go. All right, I like this question. So True Blue, if the stock market crashes, which has never happened before, how are mutually owned insurance companies affected?
Well, look back to the Great Depression. Look back to, trying to call them all out, the Black Friday crash. Look back to .com crash. Look back to the pandemic. The Great Recession. And then look back to the pandemic. Did any of those minor little blips in the market affect mutually owned insurance companies?
I think like half of them went out of business. So at least we had 50%.
I thought it was like 75%.
Of the banks? Yeah.
The bank. Oh, yeah. Steven, no, you were talking about banks, right? Oh, no, insurance companies. Not one. And someone's going to come on here and be like, wait a second, there was that one insurance company. What was that? What was AIG? That went out of business. Yeah. They were a stock insurance company that literally took excessive risky driving risks, and they had nothing to do with anything that we would ever talk about, which is giant mutually owned life insurance companies. In True Blue, by all means, please do your research and bring me back something showing me what mutually owned life insurance companies have ever been affected by market crashes.
Yeah, and ironically, when stocks crash, typically bonds and treasuries, things like that increase, and that's what these insurance companies are heavily invested in. So it actually perform very well in turmoil times, right?
Yeah, because it gives them a buying opportunity. Think of an insurance company versus a bank. A bank is highly leveraged because the bank is dealing with our money, our deposits. So they're highly leveraged, or they're dealing with the Fed overnight rate and everything else. An insurance company, what are they dealing with? Premiums. Okay. Future promises that they have to pay out on, which are very calculated because they can tell us all when we're going to die. So because of the nature of how an insurance company works and how actuarial tables work, it's a very calculated business model. So therefore, when the markets drop, when the markets crash, we'll use that word because I like it even better, and that's your words. Insurance companies literally have a freaking field day. They just go out and start buying shit, and they can. Because they have the money. And banks, what happens to banks when the markets crash? They crash.
Yep.
And
there was a question that was asked to me, and I want to see what everybody here says. What if every policyholder died with one of the mutual insurance companies? What would happen to the insurance company?
They did that stress
Say that
test.
again?
The stress test. So what if every policyholder passed away at one of the big mutual companies, or even half of the policies had to pay out?
Well, it's funny during the pandemic. It's easy. They actually had. They were required to do that, and I remember we looked at Mass Mutual as one of them we looked at, and like if they paid out every death benefit, every liability on the books, I don't remember the exact number, but it was like, was it tens of billions, Stephen, or something that they had left over? I don't want to get factual here, but I knew those numbers back then. All these insurance companies literally have the ability to pay out every single claim on the books. Would it be healthy for them? No, but you're talking about literally a mass.
It's impossible. If all the policyholders die, odds are most of the beneficiaries are going to die also. So the money's not going to go anywhere.
Right. It's a point.
Doomsday clock is ticking closer to midnight. I'm just saying.
There you go. But here's the thing.
But are we going to care at that point? You aren't going to be here.
Yeah. But that's kind of the same thing as a run on the bank. What would happen if the same thing happened to a bank, which is all the liabilities, which are the deposits, came due? The banks would collapse 100%. So where do you want to keep your money?
Well, look what happened in 1933 at the what they call the bank holiday. When people did a run on the banks, they closed the banks down because they didn't have the money.
Yep.
So,
there you go.
but when this question came up, I was kind of thinking back to one of the presentations that we all sat in. I'll say one of the mutual insurance companies we work with, their CFO is kind of giving us a lay of the land. And I've got the picture up here of their general account of assets. So it's about the portfolio size about $30 billion, and about 64% of that is bonds. 64% of that 30 billion is bonds. They've got some sprinkled around in mortgages. The interesting number that I found on this chart was 2.3% of their general account is policy loans from policyholders, people doing infinite banking, that type of stuff. So,
I was going to bring that up.
When you look at this chart, you don't see I'm in Apple stock or I'm in Nvidia, I'm in the S&P 500. It's
GameStop,
GameStop, whatever. And I think that's one of the reasons why they've been able to lock in and be so consistent for so many years is their strategy.
Yep, absolutely.
I had a client ask me, well, if everybody's taking loans out, how does that affect the insurance company? I said, do you realize it's like 2% of the whole pie chart?
Yeah, because you have to remember these insurance companies have term policies, they have annuities, they have long-term care, they have all these other products. So it's not just one big batch of policyholders taking policy loans. So it's 2.3% of this $30 billion pie here. It's policy loans.
All right, we got two more questions. Navigate your ventures. Follow up on term. Is the term rider convertible on the whole life policies? On the whole life policies, it is beyond year 7, correct?
It is, but you have to be careful to make sure it's not going to mech. But that is possible. It just has to be talked about.
Yeah, you wouldn't do it year 2. Put it that way.
And there'd be rare situations where you'd want to convert them.
Yeah. Yep.
And we just talked about this on our agent training with one of the providers we had on, and a lot of times when they do that, they just create another policy. So they'll take some of that term out of the policy you're in and then just create a new policy with that term rider conversion.
Yep. All right, J10, last question here. How much insurance can you have? Currently have GUL through work, but want to add insurance in case I leave the company. Great question.
Yep. Human life value is what the insurance companies call it. And they're going to look at your gross income. And based on your age, it could be a 20 times multiplier, 30 times multiplier, 10 times multiplier. But they're going to come up with a death benefit number that would be your maximum. That's called your human life value. And, let's say it's 5 million. And if you have 2 million of death benefit out there already and I don't think work policies apply to that. But
I asked, they said no one time. So
yeah. So it's just really, you look at your human life value, and then if it's 5 million, you can fill it up to that much.
And that changes over time.
Yeah. And GUL, I wouldn't load up on any more GUL, Jay. GUL, Guaranteed Universal Life. First off, it's a guaranteed issue product. Nothing wrong with it. Especially, it's great for people that have poor medical or that work for a company that has a guaranteed universal life offering. Like for them, it's great. But if you're healthy, Jay, never buy guaranteed issue policies. You get screwed so bad because just think about this. How a GUL or GWL or any of the guaranteed offering policies work in a workforce setting, because I used to sell these things, is the entire workforce, like the entire company has to support the sick people in the company. So, how the insurance companies look at it is they say, okay, there's 100 employees. We're going to roll out this GUL offering. We know that 5% of these people are literally on their deathbed, probably going to make it, 10 years. But we know that, 80, 90% are relatively healthy and are going to live to life expectancy. They blend that out. And all the people within that risk category are paying for those sick people. So you are literally getting significantly reduced death benefits, way higher cost of insurance, just to not have to get poked by a needle and pee in a cup. But if you're healthy, take the needle, piss in the cup with joy, and answer the medical questions and get on with life. And you'll be way better off for it.
So what you're saying, Chris, is it's a socialist.
I'm saying pissing in a cup is a social affair.
Who's Joy?
We're going to end right on that one. Of course, Joe's mind always goes to the gutter. All Joe heard was peeing and social. Like, who's Joy?
Sounds like a fun time.
Oh my gosh.
Don't invite me.
Is there anything else? We're good.
No.
You're already there.
That's it. We are wrapped up.
We're going to end on a good note. Thanks, everybody, for joining us for another episode of Ask Me Anything Happy Hour. Great questions. Hopefully, those of you that really had deeper questions, book a call. Make sure you go into the chat and grab that link. If you can't find it there, you can just go to chrisnagle.com and watch the 90-minute video and book the call there. But with that being said,
Hey, Chris,
see everybody next time. And
sorry, one thing I just wanted to make real clear. Also, in 3 weeks, we're going to be in Tampa for Money Game Live, a 2-day event, and we'd love to invite you guys to come out. So go to moneygamelive.com, and you can get a ticket. There's still tickets. It's in 3 weeks from this coming weekend. So coming up really quickly. Just wanted to mention that because it's going to be a big event, a fun time. Private Money Club will be representing there. A bunch of people from our team will be there, and it's going to be a cool event. So just wanted to mention that real quick. And, of course, looking forward to seeing everyone at Sundance this weekend as well.
Yeah, looks good. And if anybody knows Joy, please send a message to Joe. With that being said, we'll see you on the next one.